Tokenized stocks sound simple. You take a stock and you put it on chain. But the reality is a lot more interesting and a lot more technical. In this video, we'll talk about what tokenized stocks actually are, how they work behind the scenes, and why the technical structure actually matters. So in most cases, tokenized stocks are financial products designed to give you stock exposure in a blockchain native format. Sometimes that token represents a claim on a real underlying share held somewhere in custody, but other times it is a separate instrument built to track the value of that share. So right away, it isn't really enough to ask, is this a tokenized stock? The better question is, what does that token actually represent? A simple way to think about it is this. The stock usually still lives inside the traditional financial system. The token is the digital wrapper that makes the exposure easier to record, move, and manage on blockchain rails. And there is no single model for how this gets done. Some products are issued one-to-one against real shares held with a regulated custodian, while others are structured more like linked exposure, where the token follows the value of the stock without necessarily being the stock itself. Here's what one common flow could look like. A user taps buy inside an app. Behind the scenes, the order still moves through parts of the traditional market stack, usually through a broker or another regulated intermediary that handles the actual execution. Then, once the position is confirmed, the blockchain side updates. If exposure is being opened or increased, tokens get minted. If exposure is being reduced or closed, tokens get burned. So the blockchain isn't replacing the system all at once. It's acting more like a live programmable ledger for that position. And that token layer can also reflect the kinds of events that markets already go through every day. That's things like dividends, stock splits, reverse splits, ticker changes, redemptions. And for a lot of people, this is where tokenization will start to feel a lot less like a gimmick and more of like an actual value add in the form of a new infrastructure. Because now you're not just creating another system that just mirrors what's on the other side. You're connecting blockchain rails to the real operational life of the asset. And that is a big part of what people mean when they talk about a new programmable economy. Financial assets being easier to update, route, and interact with through software. So why go through all this in the first place? Because once stock exposure is represented in a blockchain format, a few things can get better. Access can extend beyond traditional trading windows, minimum sizes can get smaller through factionalization, records and settlement workflows can update faster, and depending on the product, these assets may be able to move into wallets, across platforms, or into other on-chain applications. Now, to be clear, that doesn't mean every tokenized stock product works the same way. Some offer longer trading hours and supported venues, while others still keep issuance and redemption tied to normal market hour windows. So again, structure does matter. And that leads to the most important point: tokenization does not erase the rules. Just because something lives on chain doesn't mean it's suddenly outside of financial, legal, or compliance frameworks. Rights can vary. Some structures may not include voting rights, some require KYC or jurisdiction checks, some may only be available to certain types of investors. So while the technology changes the rail, the underlying structure still defines what the product actually is. It's really about rebuilding the infrastructure that powers all of finance. So the quick TLDR is that the goal is to make stock exposure easier to issue, track, update, and interact with in a more programmable format. Different companies will choose different structures, different products will make different trade-offs, but the direction is still the same. Take a familiar financial instrument, connect it to blockchain infrastructure, and make it more adaptable to a digital-first world. That is part of the broader shift towards a programmable economy, where financial products are not just digitized, but built to move and operate more seamlessly through software. And if you want to see what this looks like in the real world, we also made another video covering live examples of companies like Robinhood bringing tokenized assets to market in real time. Catch you guys on the next one. Peace out.